How USDC Stablecoin Depegging could break many crypto firms, but Bitcoin will be stronger. How USDC Stablecoin Depegging could break many crypto firms, but Bitcoin will be stronger. USDC stablecoin is depegging, and at an alarming rate, falling to as low as 89 cents, way off its $1 peg. Volatility is expected to continue throughout the weekend as panic sets in after the Silicon Valley Bank collapse. The failure of SVB is hurting the reserve position of USDC, which is issued by Circle. Members of the consortium behind the USDC stablecoin include Coinbase, the largest exchange in the US. Coinbase could see its share price come under pressure when markets open on Monday. In a tweet last night, Circle let it be known that USDC has a quarter of its reserves in cash held at 7 banking partners, including Silvergate and SVB. USDC has $3.3 billion tied up at SVB. The remainder of USDC's reserves are in short-dated U.S. Treasuries money market funds held at BNY Mellon Bank. Unfortunately for many USDC depositors, which are mostly tech startups and VCs, the vast majority of their funds are not insured by the Federal Deposit Insurance Association, FDIC, as the guarantee only covers the first $250,000. The California Department of Financial Protection and Innovation took control of SVB and made the FDIC the receiver after depositors initiated a run on the bank by trying to withdraw as much as $45 billion on Thursday. USDC is the second largest stablecoin in the crypto ecosystem and is an essential part of the industry's plumbing. How SVB was laid low, which banks could be next? The trouble began for SVB when it was forced to sell its long-dated U.S. Treasuries at a loss. SVB had been using customer deposits to buy long-dated U.S. government bonds that it intended to hold to maturity for a small yet reliable return. This is common practice in the fractional banking model that underpins modern banking. But in order to meet deposit withdrawal demands, SVB had to sell those bonds at a loss. The Fed putting up interest rates means the value of bonds falls, because bond yields and price have an inverse relationship. That meant SVB's assets were worth less than it bought them for. It ended up incurring a loss of $1.8 billion. Again, in normal times these would not be a problem as the bonds would be held to maturity, but if forced sales take place then those unrealized losses become realized. To cover those losses, and future expected losses, SVB decided to issue equity. That's when the alarm bells started ringing among its depositor base. SVB has $175.4 billion total deposits, of which $151 billion are uninsured, accounting for 85% of its deposits. Peter Thiel's Founders Fund advised depositors to get out, which was the nail in the coffin for SVB. Bank runs are hard to stop. Banking system frailties make the case for Bitcoin as a store of value. Worryingly for the banking system, SVB is not alone in having these sorts of unrealized losses on its balance sheet, as the chart from the FDIC shows below. Other banks could now become a target for short sellers and their depositors could start to become nervous. California-based First Republic Bank, which caters to a wealthy client base, saw its shares fall as much as 15% on Friday. Other regional banks have come under pressure too. The banking system's frailties may not extend to the well-capitalized big banks, but the regulator may have taken its eye off the ball as far as the smaller institutions are concerned, as seen with Silvergate and SVB. Although it may be hard to appreciate this right now, but the unfolding drama does actually highlight the solid use case of Bitcoin as a store of value. Maybe that's why the price of Bitcoin hasn't cratered on news of the Silicon Valley Bank failure, although that